Ladies and gentlemen, good day and welcome to the Escorts Kubota Limited's earnings conference call hosted by Emkay Global Financial Services Limited. Before we start, I would like to add that some of the statements made by the company in today's call will be forward-looking in nature and are subjected to risks as outlined in the annual report and investor releases of the company. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Chirag Jain, Emkay Global Financial Services Limited. Thank you, and over to you.
Thank you, Navya. Good evening, everyone. On behalf of Emkay Global Financial Services, I would like to welcome you all to Escorts Kubota Limited Q4 and FY25 earnings conference call. I also take this opportunity to welcome the management team from Escorts Kubota Limited. Today we have with us Mr. Bharat Madan, Whole-Time Director and Chief Financial Officer, Mr. Neeraj Mehra, Chief Officer, Tractor Business Division, Mr. Sanjeev Bajaj, Chief Officer, Construction Equipment Business Division, Mr. Sanjeev Garg, Head, Finance and Tax, and Mr. Pratik Singhal, Investor Relations and ESG. We will start the call with brief opening remarks from the management, followed by the Q&A session. Over to you, sir.
Thank you, Chirag. Good evening, everyone, and thank you all for joining us today. Fiscal year 2025 has been a remarkable milestone for our company, making 80 years of spreading prosperity and impacting lives. With a successful merger, starting operation in captive finance arm EKFL, and our best ever financial performance with highest revenue and net profit. Few highlights of the company's standalone financial performance for the quarter ended March 25 are as follows. Operating revenue from continuing operation at 2,430.3 crores, up by 6.1% year-on-year. EBITDA at rupees 292.9 crores, up by 0.7% year-on-year. EBITDA margin in Q4 at now stand at 12.1%. PBT before exceptional item from continuing operation at 358.4 crore, up by 9.7% year-on-year. During the quarter, there is an adverse impact of rupees 27.1 crore on account of impairment of investment in Poland, a wholly owned subsidiary, and a joint venture company in Gujarat for small tractors. Net profit from continuing operation at 250.7 crore, up by 0.9% year-on-year. Net profit including discontinued operation at 297.5 crores, up by 8.2% year-on-year. EPS stands at 27.05 as compared to rupees 25.05 year-on-year. The board has recommended final dividend of 180% for the fiscal year 25, equivalent to rupees 10 per share. With the interim dividend already paid, the total payout for FY25 will be amount to rupees 28 per share for the face value of rupees 10 each, an increase of 56% as compared to previous year. On the consolidated basis, company financial performance for the quarter ended March 25 is as follows. Revenue from continuing operation at rupees 444.9 crores, up by 6.3% year-on-year. EBITDA as 287.6 crores with a margin of 11.8%. Net profit from continuing operation at 271.6 crores, up by 11.6% year-on-year. Net profit including discontinued operation at 318.4 crore, up by 17.9% year-on-year. Moving on to the segmental business performance, starting with the agri machinery business division. On the tractor business in Q4 FY25, the total tractor industry volume, domestic and export, was at 2.28 lakh tractors, up by 15.5% against corresponding quarter last year. Our total volume was at 26,633 tractors, up by 7.6% over corresponding quarter previous year. On the domestic front, the total industry in Q4 FY25 was at 2 lakh tractors, up by 17.3% as against corresponding quarter last year. Industry in North and Central region experienced a growth of 10%, whereas rest of the country saw a substantial growth of 25.1%. Our domestic tractor volume stood at 24,801 tractors, up by 6% as compared to the corresponding quarter last year. Looking ahead with favorable macroeconomic conditions such as good Rabi harvest, higher crop prices, and above normal monsoon prediction this year, coupled with sufficient water level in reservoir, we expect tractor industry to continue growing across various regions in the next fiscal too. On the export front, the tractor industry in Q4 FY25 came at 27,500 tractors, up by 4% as against 26.5 thousand tractors in the corresponding quarter. Our export volume came at 1,832 tractors, up by 36.6% as against 1,341 tractors in the corresponding quarter. During the quarter, sales through Kubota network account approximately 70% of the total export. Non-tractor revenue comprising of agri solution business, engine business, spare parts business in Q4 FY25 constitute 19% of the agri machinery segment revenue as against 18% in the corresponding quarter and 21% in the sequential quarter. Agri machinery product segment revenue was up by 11.1% to 1,974.8 crores as against 1,776.7 crores in the corresponding quarter. EBIT margin for agri machinery business division were at 11.4% as against 11.5% in the corresponding quarter. Coming on to the construction equipment business, in Q4 FY25, serve industry volume comprising crane, backhoe loader, mini excavator and compactor, which was down approximately 8% as against the corresponding quarter last year. This degrowth was primarily driven by the crane industry, which was down approximately 13% as compared to the corresponding quarter last year. Our total volume in the CE business were at 1,719 machines as against 1,958 machines in the corresponding quarter. CE segment revenue came at 453.9 crores as against 505.8 crores in the corresponding quarter. EBIT margin for the quarter ended March 25 came at 9.1% as against 11% in the corresponding quarter, adversely impacted due to change in emission norms regulation. As our commitment to innovation and focusing on the introduction of the new product, during the year we introduced product in the backhoe loader and hydra segment, complying with the higher emission norms. Our latest backhoe loader product is engineered for the mass market in domestic and the international market. The new crane models meet customer demand for performance, safety, and comfort in non-industrial crane segment. The construction equipment industry is currently navigating challenges in retail demand, primarily due to cost escalation on account of changes in the emission regulation. However, as the government prioritizes infrastructure development across various sectors and price stabilization following the liquidation of all old emission inventory, we anticipate an uptake in the demand during the later half of FY26. The Government of India has allocated 11.21 trillion for rupees 11.21 trillion for capital expenditure in this year budget, which is a significant portion designated for the development of roads, railways, port and urbanized initiative. Moving on to the railway equipment business division, that's a discontinued operation. Revenue for the quarter ended March 25 came at 256.5 crores as against 213.4 crores in the corresponding quarter. PBT for the quarter ended March 25 came at 62.7 crores as against 35.6 crores in the corresponding quarter. Order book for the division at the end of March 25 stands at more than 900 crores. This order book, however, excludes BMBS order for the weight wagon, approximately 383 crores, supply for which have been temporarily held by RDSO. Now I will request the moderator to open the floor for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mumuksh Mandlesha from Anand Rathi Institutional Equities. Please go ahead.
Yeah, thank you so much for the opportunity. So firstly, on the tractor industry growth outlook for this year, and also, sir, how will you be seeing the response for the new Promax series? And going ahead, what are the focus area for the new launches?
Hi, good evening. This is Neeraj Mehra this side. So, the industry outlook is positive as it has been in the past couple of quarters. So, we see a growth in the industry in the coming quarter as well as for the entire year. Coming to your second question on how the Promax series is doing. So, it's early days yet. We have yet to get into a peak season for Promax, but the initial response is pretty good. And I believe you had a third part of your question also.
And, what are the new launches focus ahead, sir? Which are the areas launches are focused on?
So, see, we have a launch in Power Track, which is planned in the third quarter. That is primarily an entire series for the southern markets. And also we have a product in Kubota in the mid segment, which is planned in quarter two. So these are the visible product launches for the current physical.
Got it, sir. Sir, how's the product development going for the exports market? Any update around that, and what are plans to enter the Europe market, sir?
So, we are already exporting to the European market. So, as Pradeep mentioned, I think even in the last quarter, the export growth has been quite good. So, about 36% growth, which has come, even though the base is low. But 70% of the export has gone through Kubota network. So, I think the export to Europe has started, even though the market conditions are not really good, even as of now, I think, as we speak. But I think the numbers for us have started improving now.
So, any outlook, sir? How do you see the growth for FY26, sir, for exports?
We are giving 20-25% growth this year or last year on the export numbers.
Got it, sir. Sir, any update on the greenfield plant in the UP, sir?
So we are in touch with the UP government. I think they already completed the acquisition of land. So there are certain formalities we need to do internally, like there's some tests which we need to do for soil, water, and topography, etc. So those things are happening right now as we speak. So hopefully, I think they have indicated the UP government is keen for us to go fast. So I think once our internal processes are completed, I think we should go ahead with that.
So the timelines, FY20 would be the timeline, sir, for the broadly, sir, around that time should be the for the plant, sir?
Sometime, I think in second quarter, we expect the formality should get completed. End of second quarter or beginning of third quarter. The acquisition of land will get completed.
Got it, sir. Sir, how is the dealer inventory for the tractor, sir?
It's in the range of 4 to 5 weeks for all the brands put together.
Got it. And sir, the dealer network has seen expansion over last few quarters. For the next year, how do you see the expansion, sir?
So hi, this is Neeraj again. So the expansion is happening primarily. The expansion focus is different for the different brands. So for Power Track, it's primarily in the southern markets. For Farm Track, it's more in the eastern side and the western side. And for Kubota, it is primarily in the northern and central part of the country. So that is the plan, and the white space coverage is happening as per the plan.
Any targets, sir? What kind of network expansion we plan to do, sir?
So it's not very feasible to give the exact numbers at this point of time, but the intent is to improve our white space coverage substantially in this physical year.
Got it, sir. Thank you so much for the opportunity.
Thank you. Next question is from the line of Chirag Jain from Emkay Global Financial Services Limited. Please go ahead.
So just wanted to get your sense. I mean, obviously in the last con call we did mention that we are largely done with the correction that we were supposed to do on the sales front, and probably the second half of this financial year we were supposed to grow market share, gain market share. So any update in terms of how things are likely to play out in terms of our market share within the tractor industry?
So, Chirag, you're right to a certain extent. the inventory levels have been brought down to the level that we had aspired for. As regards to market share, as you see, that the industry is growing exponentially in the southern part of the country, and EKL has traditionally been pretty weak over there. So our focus as we go forward is in the west and to a certain extent in the east where the industry is growing. So the intent is, as we go forward, to be at par with the industry growth in these markets.
Understood. And I think over the medium term, we have been expecting a major increase in market share. Can you share some light over there as well? Over the next 2-3 years, what kind of initiatives we are undertaking to improve, let's say, market share in the domestic market?
So you see, one thing that good that has happened in the last fiscal is that we have been able to grow market share, though marginally in our stronger markets. That was an area of concern over the last 4-5 years, wherein in the previous calls also I had mentioned that the focus primarily will be in the north and the western part. So in our stronger markets, we have actually gained in the last fiscal year. Now, for the next couple of years, the focus actually or the strategy is primarily twofold. One is how do we grow through the product side. In the 31 to 50 HP category, which contributes almost 90% of the total segment, we have already introduced Pro Max. And in the initial question, I missed out that the second phase of Pro Max is also expected in the beginning of Q4. So Farm Track will primarily grow on the basis of these complete product range and the new product range that we have introduced. In terms of Power Track and Kubota, the strategy primarily is twofold. One, on coverage improvement, and secondly, introduction of products, especially in Power Track for the southern markets and the paddy markets, which we intend to do early on in the third quarter of this fiscal.
Okay. On the export front, you mentioned that we might grow at about 20-25% this financial year. Any thoughts on the component business, because that was also supposed to start scaling up? So any update on that front as well, and also guidance if you want to share for the next 2-3 years?
Yeah, so there also I think the work is happening. So this year also the exports have been there, but it's not much. I think it's only about 100 crores plus which has been done this year. And next year they are targeting to double this number. But I think it's a slow start, but I think the work is happening there with all the suppliers, and the Japanese team also continuously working on this, the Indian team. So I'm sure that's a business which has good potential to grow. But whenever it happens, I think you'll see exponential growth maybe over the next 3-4 years.
And just last question, and then I'll come back in the queue. In terms of profitability, how do we see, let's say, this financial year, or at least, let's say, next 1 or 2 quarters, considering various drivers?
I think overall the trend will continue. I think the way you've seen for this year too, I think we expect the similar numbers should hold good, and maybe some improvement we are working on. So, over and above maybe 0.5% to 1% sort of improvement. So it depends on how the commodity prices move, in the coming year and how the market reacts to that. So otherwise, broadly, it should be in the similar range. Obviously, in the certain new product category, we'll see some pressure on the margin initially, until the time the product stabilizes and we achieve volumes, so then the margins will start improving there. So initial introductory prices will probably have some impact there. But overall, we don't expect it to be lower than this year, next year.
Understood. Thank you so much. I'll come back in the queue.
Thank you. Next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Thank you for the opportunity. Sir, first question again on market share. Seasonally, Q4 is very strong for our company, and generally it has been roughly 100 to 150 basis improvement on a sequential basis. This time it is a marginal improvement, or it's not appearing so strong. So any specific reason apart from South has reported high growth in this quarter, and is it to do anything with this merger of Kubota, that combined entity market share will not get that benefit which we used to get during Q4?
So, Mithul, good evening. See, you actually asked the question and answered it also. So, yes, what you're saying is correct. It's about South also. It's about a bit about Kubota merger also. It's also that the industry has grown in the eastern part, where there have been certain dealer legacy issues in terms of capacity. So all these have, to a certain extent resulted in the performance that we have shared for quarter 4.
And then second question on margin for tractor segment. Seasonally, it's a slightly weaker quarter compared to Q3. Still, margins are much stronger. Also for the leaders also. So any specific reason apart from commodity, are this sustainable or it was one quarter effect to some extent?
Yeah, so there are 2-3 reasons actually for this quarter to report better margin. One, in the last quarter, as you know, since we normally build up inventory in second quarter to cater to the high season volumes in Q3. So normally Q3 margins for material costs is slightly higher, and that's almost 2% impact, which you can say. So if you normalize, so which is what is reflected in the current margins also. The material cost this quarter is lower than last year. You know, the numbers are lower. So that is one reason. Second, obviously there's a softness in the commodity prices. So in this quarter also we saw a deflation coming in. So that benefit is also accrued, in Q4. So that's also helping us, in getting to the better margin.
So taking Q3, Q4 average is the right understanding. That would be the right method.
Yeah, that's right. If you look at the full year, I think more or less it reflects the, normalized margin.
Okay. And so last question on construction equipment side. Despite there is a variation in the volume, margins have now stabilized around 9-10% or even 11% previous quarter. So going forward, do you see any further expansion with help of any synergy benefit coming from Kubota Global on this side with new products, or we should assume around this level?
Yeah, hi Mithul, Sanjeev Vijay this side. Very good evening. Mithul, as far as margin is concerned, I think we don't expect too much upward jump from here. It will remain consistent for some more time until unless the demand from the market goes up, which is expected in next 1 or 2 years. So probably we'll get the advantage of volumes and scale. But as of now, this level seems sustainable. But huge upward movement from here is not expected immediately.
Yes, sir. Thanks. So one thing on clarification, in initial remark on agri machinery, you highlighted something about non-tractor revenue or anything like that within the agri machinery components and spare part and other revenue stream.
Yes, Mithul. So we mentioned about the non-tractor revenue comprising of agri solution, engine business, and service and spare part business in Q4 constitute 19% of the agri machinery segment revenue.
Yeah, versus last time 18%, right?
Yes.
Yeah, thanks. Thanks a lot and all the best.
Thank you.
Thank you. Next question is from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi. Thanks for taking my question. Just a few follow-ups. On the industry side, you mentioned positive growth. Usually you do end up giving us some guidance for the year. If you can sort of share thoughts, how positive, what are the underlying, on-ground sentiment you're seeing? And, also an update on TREM, because we were expecting some easing there, right? But I don't think that anything has so far come through. So, maybe just, talk us through the regulatory emission as well.
Hi, Gunjan. Neeraj again. So on the industry side, as I said, we're expecting a growth. So you can actually look at a mid to high single-digit growth this year. So this is for sure that the industry is looking at the highest ever volume in the Indian tractor market this year. And if all things fall into place, we are probably looking at a 10 lakh number this year. It's quite possible because all the factors that impact the industry, the forecasts for the rains have been good, initial forecasts, and all the other factors, the government focus on agri, infra, everything is positive. So we are actually looking at the highest ever industry this fiscal year. Now your second question was regarding emission norms. Yeah. So emission norms. So we the earlier date was 1st April 2026. We do not see as of now the norms getting implemented on that date as of now.
Okay, got it. But there is nothing officially out yet on that, right?
Nothing official.
Okay, and in this mid to high single digit, is it fair to now assume that a lot of the, the product gaps, etc., being plugged, there should be market share gain on a fiscal year basis in fiscal 26?
See, yes, to a certain extent, in farm track, to a very large extent, the gaps have been plugged. In power track, as I have mentioned in my initial remarks also, that we are looking at a launch of an entire series for the southern market, the paddy special series. So that, to a certain extent, again, will cover up a lot of gaps. On the Kubota side, the product range is not there. We are in the midst of introduction of a product in the key segment of the 45 HP category, 40 to 45 HP category. So once that gets introduced, the coverage of Kubota will also improve. So yes, all these will impact in the growth of market share. But as I have again mentioned in my initial comments, with the industry growth looking this year again in the southern part of the country and in the eastern part, the ask is tough. But with the introduction of these products and certain measures on the coverage side, we hope to be at par with the industry or marginally better.
Okay, got it. And just moving to margin, maybe just like sort of two-part question there. One is, when I look at the margin for the second half, roughly at about 11% EBIT margin for the agri-machinery business. Now, there is certainly going to be some of these, issues that we faced post the consolidation of subsidiaries. There has been some cost synergies, etc. Shouldn't we be expecting a better EBIT margin in fiscal 26 from this 11% range? The comment that you made was it should be at pretty much the similar zone. I mean, I would have expected some improvement there. So, any thoughts there?
So, Gunjan, actually, if you look, obviously we don't have this number separately mentioned in the public domain, but actually the margin on the domestic business of Escorts Kubota, especially on the old brand, FTPT, etc., the margins have improved. But actually, since in Kubota brand, most of the stuff is getting imported, and there we got an impact of the exchange also losses, which has come up because the rupee has depreciated. So there the cost increases pressure has been there. So that has actually further impacted the margin. So overall, the EKL stand-on margin will actually improve this year compared to the last year. So going forward, I think it's difficult to predict how the things will look because the localization is still some time away. It's not happening immediately. And as mentioned, the product which Kubota is selling, there's still a lot of import content is there. That is, next 2 years, we expect those margins will remain in similar range. Though if we continue to work on the domestic margin for our product, so there will be some possibility of improvement there. But depending on how the exchange, work out, going forward on these products, so that can actually impact the margin adversely too. So that's why we're not really going very bullish on the margin front. Maybe 0.5% here and there can happen.
Just there's a last question on this import bit that you talk about Kubota. I mean, this will change basis your comments only when the greenfield plant commissions, which is still a couple of years out. Isn't the alternative available to us that we use some of the engines that are there in the Escorts, earlier plants, legacy plants? So, is that substitution possible at all, or we have to wait for greenfield to come?
So obviously this will not happen on their platform. They will not allow us to use the Escorts engine on their brand or their product platform. But like you mentioned, we are working on a hybrid structure where we'll be using our platform and selling it maybe under their brand name. So that's where the margins will start improving. We'll have a total local content in those models. But that's again, there are challenges around the emission norm where there's no clarity right now. So it's a confusion if norms come, whether I should work on the TREM 3 norms or we should work on TREM 4 norms. So that's the issue I think which is coming up, because we start working on a total product series now for Kubota based on TREM 3 norms, and the norms undergo a change, and the entire efforts will go waste. And same thing, if we start working on TREM 4 and they don't come, then again, we'll have to restart again working on TREM 3 norms, otherwise the cost increase will make it unviable to sell. So there are some challenges we are facing on that front, but obviously the strategy, as you mentioned, is what we are following also. But there again, the lineup will sometime come maybe after, say, now 1.5 to 2 years. So it's not really something which will come immediately. But after that comes, the Kubota brand will also have complete coverage like we have for our FT and PT range. But it's still having some time away.
Okay, got it. Thank you so much.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. We take the next question from the line of Raghunandan from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity. Firstly, to Bharat, sir. Sir, on the margin side, how has been the trend in terms of commodity prices? What is the expectation for the next 3 to 6 months, given that there has been some increase of late? And second one to Neeraj, sir. One of your peers commented that there has been some reduction in the competition intensity. If you can talk about how it is, how is the discounting trend, that will be very helpful. Thank you.
So on commodity side, I think last year has been more or less flattish. So there's few quarters, I think 2 quarters some increase was there, then 2 quarters we saw deflation. So net, I think it was a positive year only from commodities perspective. So we're not seeing any major pressure on the commodity side right now. So I think it's 4 to 6 months, unless something really moves against us in the geopolitical scenarios, which we don't know right now, and difficult to comment. Otherwise, looks like the market will continue to be soft.
Thank you, sir.
Yeah, hi, Raghu. So, as regards to the market intensity, the intensity remains the same. Actually, the build-up in terms of intensity and discounts and customer schemes, it's primarily once a year when you get into the peak season of Navratras and Diwali. So everybody gets very aggressive there. Post that, the additional discounts or the customer schemes are rolled back. And that is precisely the case with us also. We are at the normal level of pricing and a normal level of discounts. So once we get into peak season, that would obviously change. So currently we are at a pretty normal level of discounts and pricing.
Got it, sir. Thank you. One last question on the construction equipment outlook for FY26. Given the emission norm changes, what is the kind of outlook expected for the served industry? And also, if you can throw some light on, given the blended shifting from TREM 3, TREM 4 towards TREM 5, or CE3, CE4 towards CE5, what is the kind of blended price increase that is expected, and how much price increase we have already taken? Thank you.
Yeah, hi, Raghunandan, Sanjeev Bajaj this side. So this changeover from BS3, BS4 to BS5 is already, it has happened. So it was applicable from 1st of January. And whatever stocks industry is holding, most of these stocks are about to get liquidated. For us, what the residual stock was over in the Q4 of last financial year itself. And for many products and for large number of high volume products, we moved to BS5 already. And so this is one. The impact to the customer is has been to the range of about 10% for products which are moved from BS3 to BS5, and about 7% for products which are moved from BS4 to BS5. All of that impact on the cost for the customer is not fully recovered. So we built that in the pricing, but it is since that mix of BS4 and BS5, both products are moving in the market by different manufacturers. So complete realization of that price increase is yet to happen. And since we are also entering into monsoon period couple of months down the line, so my sense is that by end of August and then September, when the new season starts, that is the time when full recovery of these price increases would happen. I hope I've answered. Raghu, if there is anything you can let me know.
Got it, sir. No, that was comprehensive. So basically, the volume and margin, we should see it normalizing in the second half of the year.
Yes. So from a volume perspective, this year, first half is expected to be impacted because of this BS5 changeover, because 10% increase on one type of product, and there are products which are 6 to 7% costlier for the customer. So it is definitely expected to impact the demand, overall demand, because the product viability for a customer is at a stake. But we also believe that with such high capex plans for the government this year, there will be fund flow which will start going into the market into various projects which are getting announced, but those fund flows are yet to happen. Once that happens on ground, then the demand which comes up will probably be the balancer of that price increase, and people will come back buying equipment again.
Understood, sir. Very comprehensive. Thank you. Just one follow-up to Bharat, sir. Sir, over the next 2 years, there are various efforts you had earlier indicated in previous calls in terms of synergies, cost savings, and how you could try and get the margins towards that 12-13% range. Just trying to understand how would your thought process be over the next 2 years on the margin part?
Yeah, Raghu, I think it will be something similar. I think as you mentioned, though like you mentioned, the major change will happen once we have this localization happening for Kubota products. So which is still 2 years away. I think till then, I think we'll remain in this range only, maybe 11.5 to 13% sort of range.
Got it, sir.
Unless the operating leverage play very well for us and the volumes shoot up.
I hope so, sir. Thank you so much.
Thank you.
Thank you. Next question is from the line of Vikram Damani from Damani Family Office. Please go ahead.
Hi, good evening. Am I audible?
Yes, you are.
So, given where we are today, what's the best estimate for the new plant starting date?
So, if we complete the land acquisition, Vikram, this year, which is likely, I think, like you said, by end of second quarter, the beginning of third quarter. So, the work will start from next year. So, it will take at least 3 years' time, to go live on production there. So, maybe end of February 28 or 29 beginning is what we're looking at.
Okay, thanks. In an earlier call, you'd indicated that our exports should ramp up to, geographies like Mexico, Southeast Asia, around now, maybe starting FY26. Is there anything sort of moving on those along those lines?
Yeah, Mexico will start now. I think it's already started. The distributor, which was a common distributor for Kubota and us, so that has started working now. It's operational. So we'll see the numbers will start coming in from this quarter. So U.S. market is where we thought, which is a bigger market. But now I think obviously there's some impact on the tariff unless we see a stability coming in, post some sort of negotiation agreement on that. But in the long term, I think that's one market which will really work for us. And you would have heard from, I think Kubota globally has also talked about using India as a major hub, for supplies to the world market for Kubota. So they are working on a larger plan. So all the basic tractors they want to shift to, basic and high-end also they want to shift to India. So that's the strategy what Kubota is working on. And I think we had mentioned in the last call also, there's a midterm business plan which is being reworked now. So after Kubota and this new strategy now is taking some time. And they expect their strategy will get approved sometime. I think the first cut will get approved maybe by middle of this year, and then by end of last quarter or middle of last quarter of this fiscal, they will be clearing it from their board. So once that gets done, then obviously we'll put it into our plan and we'll also then make it public.
Okay, lovely. And just the last question. Given that I think in the opening remarks you all mentioned that the finance company has started operations. Do we expect some sort of outsized market share gain coming through the finance support to our customers?
So not immediately, because right now the company is just started operation. It's only, I think, about 4 months, and they're still testing the systems and gradually opening the market. It's opened the market in UP, MP, and Bihar, but in a very selected district. But as we go along, the number of states and the districts will keep on increasing. More dealers will get added. So I think it'll take 2-3 years time to start making that impact. So I think right now the numbers will be small, but I think as you go along, the idea is they should be able to hit the similar penetration level as other captive finance companies are, which is roughly 30-35%. And when that starts happening, that will start impacting your market share numbers too.
Okay, but that ramp up will take some time.
Yeah, obviously, so it takes time to build up.
Okay, lovely. Thank you. All the best.
Thank you.
Thank you. Next question is from the line of Jaimin Desai from Emkay Global. Please go ahead.
Yeah, hi, good evening team. Thank you for taking my question. My first question pertains to exports to Europe, where you mentioned that we are looking at about 20-25% growth this year. Just wanted a clarification. Is this because of the Europe-specific products that we have introduced, or are you also seeing some signs of early signs of, let's say, some stabilizing in the European market as a whole?
So this growth is coming on an overall export number. It's not specific to Europe. So like you said, we are also opening Mexico now. We are also starting exporting to South Africa. There is a good market in Tanzania and Kenya. We're seeing good demand now. There's a large orders which are in the pipeline, which we expect will happen and materialize this year. And then Sri Lanka is a big market. And they're also looking at Myanmar, Cambodia, Thailand, and other markets where we can really look at exporting. So I think overall strategy is the export numbers will continue to go, where we'll open the markets one by one as your product availability becomes viable and you have the required products for their market. Those markets will get opened up. So this year the expectation is we should have 20-25% growth on the last year.
Got it. Secondly, you highlighted upon US being a good potential market for us going forward over the medium to longer term. There we had plans for some US geography-specific products to be introduced. What is the update on that? Is that product development still continuing?
The US, like I said, will take time. But that will be the last market they will open. But the product profile they need is different from what we are producing here. And then again, that will be something which will be coming up in the new product development program. That's what the Kubota strategy will come into play, which is what they're looking at shifting some of the production volume from other countries to India. And that will include products which are getting exported to US market too. But that will take some time. I think once you get a plan from Kubota Japan in this year, I think then we'll be able to form a strategy on the overall operation for that. But US is the biggest market for Kubota. I think it's almost 8.5-9 billion, turnover comes from that. So Kubota is the biggest market outside Japan. So obviously the numbers are good there, and Kubota is the market leader in the compact tractors in that market. So actually, as and when the product starts getting exported to the numbers for them.
Understood. And finally, I know you spoke about a slightly gradual ramp up of the component exports. But just from an opportunity point of view, the overall opportunity at about $500 million, assuming about 5% shift from Kubota's current global sourcing, that sort of opportunity still remains intact.
Yeah, so like I said, the potential is huge. Obviously, a lot will depend on how many products get localized, because your margins on the manufactured products in India will be much better compared to the source product from the outside vendor, which will be more like a trading activity. So even though the revenue may come up, but the margins may not be good enough, to really continue building on that. So our idea is to have a good mix of the manufactured product as well as the traded products from the supplier. But like I said, obviously, Kubota is sourcing more than $1 billion for the company in China today. And they are also looking at China. India obviously has an obvious advantage over there. I think issue they are facing is getting good vendors which can meet their quality requirements, which is where I think it's taking time for them to build up. The testing processes are stringent. And I think the team from Kubota as well as India, they're working jointly to, promote this business in India.
Understood. Thank you. Those are my questions.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. Next question is from the line of Vijay Pandey from Nuvama. Please go ahead.
Hi, sir. Thank you for taking my questions. I just wanted to check with you about the industry outlook in the domestic market. If you can guide a bit about the domestic market and also region-wise, for which, whether north or south, which will be the dominant region for the growth in FY26.
Hi, Vijay. So as I've already mentioned, we are looking at industry growth this year, probably in mid to high single digit, which will actually take the overall industry to the highest ever for India. Now, coming to the regional spread, we believe that the focus or the growth of the industry primarily will be in south and to a certain extent east. The northern part or the central part of India last year also was kind of stagnant. It was a marginal 2.5-3% growth, and we expect that only that similar growth will remain in the north. But the primary growth actually will come from down south and the eastern part of the country.
Okay. And so, can you share what is your strategy on the construction equipment side? Because the sales have been declining, and probably we have also lost market share in construction equipment. So if you could just briefly tell us what is your mid to long-term view on the industry and how are you planning to tackle the decline in the sales?
Yeah, Vijay, good evening, Sanjeev Vijay this side. So first of all, I would want to correct here that market share is not declining. So we should see this product by product. So as we have two sections of business. One is material handling and compaction, and the other business is earth moving, which includes mini excavators of Kubota and backhoe loader. So for last full year, our crane market share is intact. There is a small decimal percentage of increase. There is no decrease there. And also we have gained the market share in mini excavator. Currently, we are number 2 player in the crane segment, and we are number 1 player for this calendar year and financial year in mini excavators. The challenge products for us are backhoe loaders and compactors. And compactors also, largely the market share is down because there is a huge volume increase in the exports business for the industry, which of course is not a strong play for us because all the multinationals, they have their manufacturing in India and they are exporting through their subsidiaries. But as far as backhoe loader is concerned, yes, there is a huge headroom available, and we have lost a bit of market share this year. It's about 0.2% down from last year, and it has also not been traditionally a very strong segment for us. And that is the reason we are focusing on creating completely a new platform, which we introduced and showcased in January to the public in BOMA exhibition and then Bharat Mobility exhibition. And that platform has been developed which is very modular, which will take care of the domestic demand as well as it will also can be adapted for various different specifications in various markets worldwide. And this product, we believe that we have done a very good job, and the initial reaction from the customers who have seen this product and the dealers is very, very positive. And we believe that this segment where we are very weak, we should be able to turn it around. Now, this is the first platform which we have introduced this year, and there are a couple of more versions of this product line which is expected to come along with a premium range which can come with Kubota engineering and Kubota engine and other interventions. So I don't see that for us the challenge is attaining a good position in the market. Overall, the industry is going through a tough phase. Last year, of course, because of the assembly election, this was the year. Every year the industry is down, and this year also the main industry, which is crane industry, is down by 13% in the last quarter, and overall about 8% for the whole year. But I think in the second half of this year, as I said, things should start doing well. And next financial year is expected to be again a very high year, because all the emission norms and other things which are currently the hindrance will go away. So we believe that we will do well. And also on the strategy front, we are very focused on our product lineup for the future. Our focus is creating more value for the customer, bringing the cost down for ownership of the customer as well as the operation cost, and also giving right products for the right application. And that focus we will bring more products in next 2 to 3 years time, which I think will put us in a very strong position. So we are very confident. So let's see how things go from here.
Thanks for detailed answer. Just want to clarify, you mean the construction equipment industry will start improving from second half FY26, right?
Yes.
Okay. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to one per participant. Next question is from the line of Rishi Mora from Kotak Securities. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Just one small question. What was the CapEx guidance for this year, FY26, and even if you could give it for FY27?
So for FY26, we expect to be somewhere between around 350 to 400 crores. And mostly this is excluding any investment cost, greenfield. So if the land acquisition gets done, there will be another 450 to 500 crores this year.
Okay, so most likely we should do around 1,000 crores, including land acquisition this extent, approx. 800 to 1,000 crores.
Less than that, I would say about 800. Yeah.
And should we expect that trend rate to sustain going into FY27 as well, given that the overall capex outlay is around 4,500 crores for next 3-4 years?
So that still needs to be worked out, because light launch in the project is delayed now. So I think they also need to look at the existing capacity, how much we can ramp up in the existing place. The end of the day, we're also looking at the ROI to be there on the investment which we do. So the volumes have to justify, any fresh investment which will happen. So land acquisition is one part, but I think we'll get enough time to commercialize there, in that area, if we require the land. So I think as the volumes come, then we'll obviously follow that. Because there will be lead time which will be required is minimum 24 to 36 months for any capacity to come up. So we'll have to take that into account based on how the volumes ramp up happen, and then based on that plan, how the production should come into the greenfield.
Understood. Thank you, sir.
Thank you. Next question is from the line of Mitul Shah from DAM Capital. Please go ahead.
Yes, sir. Thanks for opportunity once again. Just clarification, you said that after land acquisition for plant to become operational, it will be 24 to 36 months, right?
Yeah, that's the minimum lead time after you commission the construction there.
And so this 400 to 500 crore related to land you highlighted is purely land purchase related cost, or it will include anything on the building the plant also?
No, this is essentially land related cost.
And so lastly, on the cash and cash equivalent, this 1,600 plus 110, 1,710 crores from the Sona BLW already received, and excluding that, how much is the cash on balance sheet?
No, so you would have clearly seen the intimation. The closing date was extended to 1st June. Well, certain approvals which were required did not come through, so we had extended by another month. So it was supposed to happen on 1st of May. Now we're planning to do it on 1st of June. So after the closing, there will be some money which will flow into our account. And since the approvals will be received post the closing only, so some money will still lie in the escrow account. So free money will not be 100% available to us upfront. I think once you get the approvals in place, with the long stop date, I think is September or October. And after that only the money will get released to us 100%. Some money will get released to us, but not 100%. So hopefully within this fiscal year, everything should get completed in that.
Yes, sir. And cash and cash equivalent, excluding all this amount, as of end of fiscal. Hello. Hello.
Thank you. Next question is from the line of Raghunandan from Nuvama Research. Please go ahead.
Thank you, sir, for the opportunity. Just a follow-up. On the captive NBFC, what would be the equity investment so far, and what is the plan for FY26? And also, if you can share what is the current book size? Hello, I hope I'm audible.
Yes, sir, you are audible. Please give me a moment. Hello, everyone. We have the management connected again.
Hello, am I audible?
Hi, Ravi. Yeah, sorry, the line got disconnected in between. Yeah, please go ahead.
Sir, just a follow-up on the finance business. If you can indicate what has been the equity investment so far and the plan for FY26, And also, if you can tell the book size.
So far, we have done investment of about 60 crores in the finance company. The total approved investment right now, I think, is about 200 crores in the initial phase. Then the finally it will go up to 700 crores. So the balance, I think, amount will get injected in FY26 into that company gradually, as and when the book really gets built up. So as of now, the book size is very small. I think they're, like you said, they are more testing the systems and gradually opening the dealerships. I think by end of FY26, they'll be sitting on a book size of maybe close to 100 odd crores. But the ramp up will have happened. So I think we expect maybe 5-6 states would have happened by then. And next year, I think the ramp up should get completed on a pan-India basis. So we'll see the faster book building happening this time.
So by end of next year, we will be investing 700 crore?
So initial approval right now with us is for 200 crores of capital. The authorized capital is 700 crores. So I think we still need to get the approvals from Kubota in Japan, from the head office for the balance. But yes, the overall outlay which we have projected was 700 crores in capital. The balance will be more leverage.
Got it, sir. And I think the previous question Mithil was asking was the cash reserves, if you can share that.
Yeah, so I think the line got disconnected. So I'm telling him in the March end, we have almost 6,500 to 6,600 crores of liquidity. And this is after paying off the debt of the merged companies, which are almost 350 odd crores. So with this railway deal getting closed, post taxes will get maybe another 1,400 to 1,500 crores out of net cash. So maybe by next year end, after taking into account the fresh cash generation and the capex and the land investment, maybe we'll be sitting at somewhere around 7,500 to 8,000 crores out of cash on the balance sheet.
Got it, sir. And would that mean that would you consider anything on the dividend policy where the payout can increase?
So we are gradually increasing the payout. So as you can see, even this year, the dividend which is announced is almost 25% of our profit. And I think our policy says to go up to 40% gradually in the midterm business plan. So that's what Kubota follows globally. And from the free cash perspective, obviously this is almost 30-35% now this year. So I think we'll continue to expand that. So that's the idea. So idea is also to maintain the dividend and sustain the level. So not go down from the level that we are already distributed. So that's I think the momentum which we would like to continue with.
And also payout could be in the form of buybacks also. Would that be possible?
So buyback would have been a good option actually, but because this tax changes, so we don't think for the investor perspective this is very attractive now as an option. And the first preference would have been to do that because they spoke to buy back 5 to 6% of equity from the market and given the cash to us, so it would have really made sense. But I'm not sure from the tax perspective now, really, if it really makes sense to go with that option. So maybe distribution will be a better option rather than buyback.
Understood, sir. Thank you very much.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen, for being present on this call. For any feedback or queries, please feel free to write into us at investor.relation@escortskubota.com. Thank you very much and have a good evening. Thank you.
On behalf of Emkay Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.